Okay, welcome to the September 19th edition of the Fats, Fuels, and Oils webinar. This week, we're going to talk about, Joao is going to talk about palm oil and last week's Malaysian Palm Oil Board report and what it means for the supply and demand. And then we're going to talk a little bit about what's going on with crush and refining margins and what that could mean for crush and in biofuel production, and our outlook for this Thursday's EMTS data. I'll talk a little bit about sort of what's going on with the crop now, although we're really winding down, and then I'll turn it over to Joao. So we are in sort of the final stages of the U.S. crop development before harvest well and truly gets underway. It seems like the rainfall over the last couple of weeks has probably been, while not 100% of what farmers probably wanted, better than expected, I would say, even if only marginally, and maybe good enough to help support the yields in some of the drier areas where there were real concerns. I haven't looked in depth at the data in a little bit, but just sort of anecdotally watching the radar, I saw storms go through parts of Nebraska and in North Dakota, and so it does seem like there was at least enough rain around that crops in those areas may not be as bad as people, including myself, had worried about. Certainly when the forecast was calling for 90-degree days and no rainfall to start the month of September. As we get into harvest, we'll get some yield reports from farmers, and then we'll probably have a much better idea of what we think about the crop and ultimately the supply of soybean oil for the 23-24 season. All right, with that, let me turn it over to Joao, and I will have him go through the MPOB report.
Thank you, Tori. My apologies for everyone. I'm having some problems with my camera today. I don't know what is happening.
Sorry.
So I have my video off. Sorry.
Oh.
So today I'll have a quick contribution to our webinar. I'll talk a little bit about the MPOB last estimates, and I will try to update a bit what are the impacts for the palm oil markets. So last week, the Malaysian Palm Oil Board, they published their estimates, and basically they are pointing to the maintenance of the strong production pace from the past 2 months. We are seeing we're seeing a quite strong months, and market was expecting, with the shift from the La Nina to El Nino, which will disrupt the weather patterns in the southeastern Asia. So it will lead to a drier and hotter weather. Market was expecting that this shift would already affect the production in Southeast Asia. However, as palm is a permanent crop, first, the weather, we had a pretty significant rainfall levels in the first half of 2023 in Malaysia, and that helped building a good moisture levels in their soil. And also, even if we didn't have that much of rain, as palm is a permanent crop, different from soybeans, the drier weather will take longer to affect palm yields. So we are expecting that yields will go down, but they will go down mostly after the first quarter of 2024. So we were expecting a 1.8 million tons of production in August. MPOB released a 1.75 million tons. So we were 100,000 tons above it. Market estimates, the median of market estimates was 1.5, so we were way above the market, but not that high when we compare to the MPOB estimates. And we were also seeing a exports slowdown. So as you can see it, we had a almost 100,000, more than 100,000 tons drop from July's numbers. Market was a little bit more aggressive than us, and because we're seeing a lot of demand coming from India, especially some of their demand from China. And in the past month, we didn't see that strong demand coming, especially from India, and that's why we are seeing this 100,000 tons drop from July numbers. And the combination of this strong production and the slowdown on imports, they caused a big build up on stocks. So they surpassed the 2 million tons threshold. We were expecting a 2,050,000 tons, but MPOB estimates was quite a way more aggressive. They published a 2.1 million tons, and that 2 million tons threshold, usually when you look at the historical data, it's a kind of a threshold for CPO prices. So when we see that stocks are above 2 million tons, prices will go down, and the opposite is also correct. So, and we already saw that last week on the Dalian exchange. We saw that contracts for futures palm oil, they traded below the 3,800 ringgit per ton. Now they recovered a little bit, but that supports our scenario of a bearish crude palm oil prices. Can you please move to the next slide? Sorry, thanks. So as you can see it, Malaysia is building quite big monthly stocks. We are 30% above the past 2 seasons average. And as you can see it, if you look to the first 11, we're just a month missing for this current season. And if you look at it, we have 7 months that already surpassed the 2 million tons threshold. So again, that supports our scenario of smaller of prices drop on the palm oil. But if we have a severe disruption in the Malaysian weather pattern, especially on the first quarter of 2024, we may see stocks going down. Malaysia recently is rising quite a bit their domestic consumption, especially for biodiesel usage. So we may see a bullish driver with the combination of a stronger domestic consumption from Malaysia, and also the yields drop if El Nino effects come as strong as the market is expecting. And with that, can you move to the next slide, please, Tori? Thanks. And with that, we can see the last time that I brought you guys the updates on the RBD on the palm oil market, we brought this graph, but the graph was RBD palm oil and also RBD soybean oil, both from the Gulf. Actually, RBD palm oil from the Gulf and soybean oil from Central Illinois. But now we choose the RBD palm oil and the crude degummed soybean oil spread. And as you can see it, soybean oil had a rally on June, especially after USDA cut their estimates on the soybean acreage in the current season in the US. And basically, palm oil didn't follow the trend and stayed and was able to sustain that steady level, that steady price level. But if we look a little bit behind. We can see that the spread of 2023 is much wider than 2022. We are 11% above 2022 average spread, and this big spread that is over 20-cent spread can and is already making some some disruptions on the US market. So we can say that okay, it's a 20 cents, it's a over 20-cent spread, but it's not the soybean oil is not refined. But when we see the spread between RBD soybean oil and crude degummed soybean oil, we'll see that they have a 8-cent spread. So we are missing another 13 cents, and that is already causing some impacts on the US domestic demand. And as we can see in the next slide, we are rising the US already imported much more soybean palm oil than the last season. We are 16% above the same period in the last season. So for the first 10 months of the current season, and basically what supports this growth in the palm oil imports is the growing demand for feedstocks from the biofuels industry in the US. So as the market has less vegetable oils available in their market, some players, not from the biofuels industry, but from the food industry especially, and the feed industry as well, they're looking for palm oil as a substitute for soybean oil in the US. And because of that, we are expecting an even more aggressive growth in the palm oil demand for the next season. So we are forecasting a 23% growth in the palm oil imports from the US in the 23-24 season. And that's my short contribution for today's webinar. And I leave you guys with Tori with his excellent presentation. Thank you very much.
Thanks, Joao. All right, so let's talk a little bit about, we'll start off with first the spread between soybean oil at the US Gulf and in Argentina. And you can see that the spread between the two has remained unusually wide, and just based on some simple calculations, if we add the tariff cost and we add the cost for EPA certification, that basically leaves a gap of about 16 cents for producers in the Gulf or really anywhere in the country to import Argentinian soybean oil and then ship it to their location. So the shipping costs are unlikely to be, I guess, 16 cents. And so this arb still remains open. And but I still believe sort of the same thing that I thought the last time we talked about this, which is while it remains open, it's going to need to convince end users that it's going to stay open for a very long time before they will really start to switch in a big way, and we will see significant Argentinian soybean oil imports. Now, I really am not sure that we're ever going to get to the point where we see the US import a billion pounds of soybean oil. In theory, it's possible. Argentina next year should certainly have the soybean oil to ship, and if the economics continue to work, biofuel producers, especially the newer entrants into the ag industry, probably are more likely to import soybean oil from Argentina and process it, and particularly if they're at the Gulf and they don't have additional logistical costs to get the fuel beyond sort of the New Orleans port, or not very far beyond the New Orleans port, I guess. So in theory, I could see this, and it's something that we'll watch really closely, but it's not something that we have really incorporated into our forecast yet. If we do start to if the people that we talk to in the industry do start to talk about switching and importing soybean oil, then we probably will start to include it in our prediction for U.S. soybean oil imports. But until we get to that point, it's kind of one of those things where I'll believe it when I see it. There's been periods where I've forecasted big U.S. imports, and those never really came to fruition. And part of that was, of course, because the economics didn't really work that well. There was just a big gap in our prediction of feedstock demand that needed to be filled. And so we used to fill it with soybean oil imports. Now we do it with canola oil imports, which may have its own problems starting next year. But in the interim, we'll leave our soybean oil imports kind of where they are, around 400 million, and maybe we'll creep it up a little bit slowly if the ARB persists. But if it doesn't, then I think soybean oil imports around 400 million pounds is probably a relatively good place to start in any given marketing year. This, however, is a little reflective of what's been going on with refining margins. So if you look at refining margins and actually you look at Gulf basis, there is a little bit of a relationship there. Now, part of that is just natural because Gulf is crude, and so the difference between Gulf basis and Central Illinois basis for crude to gum should really only be the shipping cost from Central Illinois to the Gulf. And other than that, they should be relatively aligned. But where it starts to get a little less aligned is if you compare RBD, because then you start to include the refining margin, and refining margins have continued to come down. So they were about 10 cents or so, I think, last week or over the last couple of weeks, but they narrowed down to about just under 9 cents this past week. And it does seem like my spiel on RBD basis over the last year or so has been, if you think about RBD basis as some combination, or as a combination of the crude basis and then the refining margin, what we should see as renewable feedstock demand, renewable diesel feedstock demand increases, but also pretreatment increases, you should see less demand for RBD and more demand for crude to gum, which would suggest that crude to gum basis will remain relatively high. The refining margin will shrink, and then that will leave RBD basis elevated, but maybe not at the same level that it was over the last couple of years. And to some extent, that's kind of what is happening, but it doesn't really feel like, I guess, I thought it would. And that's not really something you should ever hear your analyst say, but it doesn't, this feels a little bit less like what I thought would happen, and a little bit more like something that may be the result of either a slowdown in demand or just a little bit of hesitation in end users' purchases, which I can understand given our expectation for prices. If I were an end user, I would probably be waiting to kind of see what happens right now. Now, all of that said, I'm going to spend most of the rest of this week's webinar telling you how absolutely wildly bullish soybean oil prices are for biofuel margins. And if that's true, then basis for both crude and RBD should expand in the coming months, especially if the US crop isn't quite as big as USDA predicted in September, in their September report. For the RBD basis and the refining margin, I think, well, we predict a recovery in the margin. not back to the levels that we've seen certainly, but probably out to 10 or 11 cents, I think, if I'm sort of remembering our predictions correctly. And then kind of starting to slowly come down over the second half of the next year. And crude basis, we have it at this level or maybe just a little bit higher. So it's not necessarily that these markets aren't doing sort of what we expected. I think it's probably, as I've sort of talked through this, I think it's probably more the fact that the refining margin has fallen a little bit faster than I expected. And if I had paid attention to this chart, which is really, really busy, and I spent a fair amount of time last night trying to fix this chart so it wasn't so crazy, but it is what it is. There are a couple of things on here. So the gray bars are the refining margin, the average monthly refining margin. The black line is the cash crush margin using RBD soybean oil for the soybean oil component. And then the purple line is the oil share. And so you can see oil share, which roughly kind of approximates RBD basis a little bit. At least if you line them up on the graph, it does. There's not a real great reason why that should be, but oil share about traces the price for RBD or RBD basis really. And that peaked way back in June of 2021, which was a little bit of a surprise for me, I guess. I was just remembering last summer's highs or last spring and early summer's highs. But crush didn't peak until November of this last year. And so while pulling all of this together is it's a little strange, I think. I think this is a bit of a strange argument to make. What we can say for sure is that crush margins have been supported recently or in the past year more by strength from soybean meal demand than the historically high prices for soybean oil that we've seen. And that soybean meal demand has really been at record levels. If you look at sort of domestic soybean meal consumption on a daily basis, we set records for most of this marketing year and really only slowed down significantly in the last month or two. And the question is really, what will that do to the crush? Now, as you can see from this chart, crush margins are well above the historical average. If you look at the 200-month moving average for board crush, it's about 95 cents. And board crush right now is I think $2 or something, and I guess it's just below 250, or it was just below 250 yesterday. And so cash crush is obviously quite a bit higher. But if you look at what board crush has done recently and assume that cash is relatively reflective of that, it has dropped from the highs that it saw certainly last winter. And part of that is because refining margins and soybean oil's contribution peaked a year before that, but the recent decline has been because of weakness in soybean meal demand and soybean meal prices. And that's kind of why I ended up putting oil share on here, because ultimately one of the things that we all of the analysts have talked about is that at some point, based on what the fundamentals look like, crushers are going to need to crush. They're going to need to match their crushing volumes with their oil demand rather than their meal demand, which is what they've been doing. And that has allowed them to provide enough oil to meet the demand from both the growing biofuel feedstock market and support the non-biofuel end users with essentially the same volumes that they had before the growth in biofuel feedstock. As meal demand slows, crush demand will initially slow so that the crushers can continue to meet the demand from the soybean meal end users. At some point, that is going to mean that oil production doesn't meet up with oil demand. And given the fact that we all expect oil demand to continue to grow, at some point it makes sense that the amount of oil supplied would not meet the amount of oil demanded from biofuel broadly and renewable diesel producers specifically. And at that point, oil share is going to have to go above 50% at least to encourage crushers to crush more beans and essentially to make up the difference. Now, crush margins, like I said before, are still way above where they were. They're about 2.5 times essentially what you would expect the long-term average to be. So we're in the upper end of the historical range, and we've gotten record crush volumes this year, and the crushing industry is going to expand their capacity, both for crushing and refining. And so they should be able to continue to expand the supply of soybean oil enough to meet the demand for renewable diesel producers. However, since they would prefer to match their crushing volumes with meal demand, since you can't really store meal in the same way that you can store oil, that's going to mean two things. One, it's going to mean, again, that oil share is going to need to go up, and the price of oil is going to need to compensate for the loss of margin due to declining soybean meal prices. The other is that it means that crushers are probably going to overproduce meal. And the really quick answer to that problem is you just shove all of the meal into the export channel, and whatever the price is better than letting it spoil in a warehouse someplace. And so that'll put pressure on prices, and ultimately it will have some kind of impact on probably the Argentinian crushing industry. However, I think that that will also put more pressure on crush margins, right? So if exports are going out and then that pressures prices, or export prices fall further than domestic prices, crushers will ultimately lose a bit more margin for every ton of soybean meal they export. The reality of it is probably going to be a lot more complicated. There are a lot of protein meal substitutes, I guess, that can be used in feed rations. And so while it's easy to say, oh, we'll just export all the excess, and that's kind of how we deal with it in our balance sheet forecast, it probably means that domestic prices will fall a bit more than expected. And you probably will also get pressure on the substitutes for soybean meal. So like dried distillers grains or other oilseed meals, their prices probably will also come under pressure. And there will be some substitution domestically using those soybean meal substitutes, and then similarly, sort of in the destination export markets, you'll probably get kind of similar calculations, which are how much can we import soybean meal for, what's its protein percentage, what does that equate to in cents per percent of protein or whatever, and then compare across different protein meals that way to make their decisions. It's tough to switch rations on livestock. Anybody that has ever had a dog and fed it the same dog food for 4 years and then switched dog food knows that if you don't kind of slowly work it into their diet, that it can cause problems for them. And cows that get milked, or beef cattle, or chickens, lesser degree chickens because they don't really live that long, but the other livestock, it's very similar. So again, while Econ 101 would say, okay, well, we're going to produce too much soybean meal, the price is going to go down. We probably will use a lot more domestically and we'll probably export the excess. The reality will be a little bit more complicated because of that, because of substitution, because substitution is not as easy as sort of Econ 101 would lead you to believe. I know that when I worked at a dairy at one point, and there was a brewer down the road that had a load of DDGs that the person that typically bought them couldn't buy them. And so they called us up and they said, hey, we've got this load of DDGs. We'll give it to you free. We just don't want to waste it, or we don't want to have to dispose of it or whatever, but we'll bring it over and drop it off and you can have it. And we called up the vet who did the nutrition for the animals, and ultimately decided that it wasn't worth it, even at free, to disrupt the animals' sort of feed routine for a relatively short period of time. And while that's kind of an extreme example, it's just one load, you can't really drop that into the ration. It is an example that sort of highlights what's going to happen in the meal market in the coming years. For soybean oil, in terms of how does soybean oil go up to offset the decline in margins from falling meal prices, assuming they continue to fall. One, you have to assume that on some level, crush margins probably don't stay at 2.5 times the long-term average. So probably some of the decline in margins from falling meal demand will just be a decline in margins. However, if we assume, and this is what we assume, that a large crop in South America will pressure flat prices in oil seeds and vegetable oil markets around the world, then that means that the futures market goes down, but we still need to encourage crushers to crush. And so ultimately, what I think that means is that basis levels probably go up. So soybean oil basis, whether it's crude or refined, probably goes up as this starts to happen. And oil share breaking above 50% and then maintaining that level will be a really good signal that we're probably already crushing for oil or getting ready to crush for oil. And while the 2021 version of 50+% oil share was driven maybe as much by sort of excitement about the growth in renewable diesel and speculative activity and that kind of thing, this is probably going to be a more sustainable period of high oil share relative to the long-term average. And that ultimately will mean that basis levels probably will also remain well above their long-term average. And so while I'm really bearish on flat price, I'm almost equally, although not quite as much, and I'm probably not quite as bearish, but bullish on soybean oil basis for this reason, because unless we start to see a real pickup in soybean meal feed demand, then oil is going to have to do what it's ultimately going to have to do at some point anyway. Given the anticipated growth in renewable diesel and then SAF production, it's very hard to understand unless there is a real hard cap on the amount of vegetable oil that you can use to produce biofuel in the US, which I will be a little surprised if it happened nationally. In California, I can definitely see it, but to do that nationally, I think would probably limit the amount of biomass-based diesel that you could produce in the country, which would ultimately limit the goals of transitioning to more sustainable sources of fuel. And I don't think that either side politically in the US can or will necessarily roll the RFS back so much that that trend stops. And I think that for two reasons. I think that while in the last administration, we saw the use of SREs more than we see them in this administration, which is none. And they may do that if the election, if Republicans win back the White House, you may see something sort of similar. But that's sort of a stealth edit of the mandates. I don't think that either side will be bold enough to go back and really decrease the mandates. And maybe I'll be proven wrong here in a couple of years. But I think that one, the energy industry has invested a lot of money in renewable diesel facilities and or partnerships with renewable diesel producers. And two, even if that's not your constituency, farmers are depending, not necessarily depending, but farmers also enjoy the benefits that the RFS brings them. And so cutting the RFS would impact farmers' pockets, and I don't know any politician that really wants to make farmers mad in the US or in any other country. Okay, so what does all of that mean for feedstock profitability? You can see that over the last couple of weeks, profitability really has exploded, and that has been primarily due to the rally in energy prices, which has really been driven by a rally in diesel prices or heating oil prices. If you look at the relative movement of gasoline futures and diesel futures over the last couple of weeks, diesel futures have just kind of continually been moving higher. And I think that Joao and I were talking earlier this morning, and I was telling him about that, and he kind of said, well, is it a supply issue or is it a demand issue? And I said, honestly, I don't really know. I haven't really heard anything about refineries being down or anything like that. But it seems more likely to be sort of a supply issue, I suppose, and a demand issue, because I don't know that the demand changes that much outside of like the COVID lockdowns. Other than that, diesel demand, if you look at it sort of year to year, is relatively stable. And so in theory, if it's a supply issue, it probably will take a little while to sort out either way, actually. And that leaves our renewable diesel price forecast, or renewable diesel and biodiesel price forecast, elevated compared to where they were over the past couple of months. And that has driven profitability up sharply from where soybean oil was when it was down negative 60 cents or something like that a gallon. Or for RBD or our renewable diesel, it looks like it was almost down $1 a gallon. Now everything is back to positive, and soybean oil has actually done relatively well because most of the fats and greases have been relatively steady over the past month, and soybean oil prices have been a little wobbly, but generally have been a little weaker relative to at least the last time I put this slide together. So right now, the average profit for soybean oil is 15.2 cents. That's good. It's not at the top, and it's actually below if you look at vegetable oil as a subset. The average profitability per gallon is nearly 50 cents, but that is way below if you look at just the fats and greases. All of the rest of the fats and greases, it's almost $1.40. If you exclude UCO and yellow grease, because they are substantially above the rest of the commodities, then you get a 92-cent average to compare against the 47-cent average for soybean oil. So while it's done much better, it still remains kind of, vegetable oils broadly remain sort of in the lower end of feedstock choices for renewable diesel production. For biodiesel production, it's a little bit of a different picture. And so for biodiesel production, it looks to us like soybean oil is like the third most profitable feedstock right now. So you would basically substitute it for everything except for yellow grease and UCO. And it looks like profitability is about 22, 23 cents a pound if you're selling into the California market, and about $1.60 a gallon if you sell outside of the California market. And this is part of the problem that we have with our biodiesel margins. So if we just look at soybean oil, our biodiesel margin forecast, if we just look at soybean oil across all the markets, you can see that, again, it was really negative. It's come back, and it's probably relatively close to where it's been, sort of its historical average. But our forecast right now is really driven by the idea that futures prices are going to fall as the size of the South American crop is assured. So as we plant, the market will probably take a little bit more weather risk premium out of soybean futures, and then by extension, soybean oil futures. And then as the crop matures and develops and gets harvested, the market will kind of continually take out more risk. Where that ends is certainly up for debate. So at our biofuels conference in Rotterdam, I presented our outlook for soybeans and was asked a really great question by somebody in the crowd, which is, if you have a 5% stocks to use ratio in the US, that implies soybeans should be $14.5, and you're showing 10 something essentially. And I said, well, if you look at stocks to use ratios to predict prices, that if you just use the US, that actually works fairly well for corn. That probably will change as Brazilian production rises. But for soybeans, you have to look at not only the US, but you have to look at South America. And so you have to calculate South American stocks and then line them up with US stocks and calculate the stocks to use ratio. And then you'll get a much higher stocks to use ratio, and you will get a prediction of lower prices, maybe not down to $10, but certainly below 14 or $14.5. And so if that part happens, then soybean oil futures will follow soybean futures lower. It's, again, that relationship has changed, but the R squared over a very long period of time is still 85 or 90% or something like that. So maybe that R square falls to 80% or 70%, but it still will have an influence. Domestically, the demand is going to be really strong because renewable diesel producers are going to continue to open up and expand production. So far, we haven't really seen a big impact on non-biofuel demand. And so we sort of very quickly get into a spot where it's easy for me to predict soybean oil stocks that are well below 1 billion pounds if I don't really kind of work at it not doing that in the coming years. And so that suggests that prices certainly shouldn't go down with soybeans, and that relationship not only shouldn't exist anymore almost, but it should break, and soybean prices go down and soybean oil prices go up. That's not impossible, but it just isn't the way that it has worked traditionally. And I think that, and this is why I'm so bullish on basis, I think that most of that effect gets translated into the basis. And so given that a lot of end users are very focused on basis, it's hard for me not to be bullish on basis because of this setup. And this is what, when I showed it, and I'll show it again here. Let me actually, I should have done this a little different. Our margin forecast for biodiesel. And again, just to remind everybody, because our charts don't show it, our feedstock mix for biodiesel is 75% soybean oil and 25% yellow grease. Our feedstock mix for renewable diesel is 50% tallow, 25% DCO, and 25% UCO. So renewable diesel kind of also represents the fat and grease margins, while biodiesel also represents kind of the vegetable oil margins. And because our biodiesel model is so soybean oil intensive, that combination of higher energy prices and falling soybean oil prices gives us margins that are just crazy. And the last time I put this slide up, I said, look, I don't know that I really think the margins are going to go to this level. I still don't believe that. But it also is a little difficult to balance the South American crop, the U.S. demand, and the basis levels. You end up predicting numbers that seem outrageously high. And while you don't necessarily think that we'll reach those levels, it does seem like basis is probably maybe a little weak, at least given where we've been the last 2 years. Now, another thing that I think could potentially happen is that if you look at what happened following the 2005, 2006 sort of biofuels, the initial biofuels build out for ethanol and for biodiesel. I put a chart up one time that showed sort of what happened to prices during that period. And essentially they doubled, or a little bit more than doubled, and then they came back down and settled in at about double where they were before. And when I put that slide up before, what I said was, look, we were at 30 cents. We went up to 90 cents. So we kind of tripled, and then we came back down. And so 60 cents, 55 cents, somewhere in there, a doubling would make sense based on what we saw the last time. And if you look at what prices did during that period, you had if you look at the future side of it, you had a big run up, and then prices came down and settled. If you look at basis, there wasn't really a huge, significant long-term disruption in basis. If you think back to the chart that I showed earlier, that showed the two basis levels, basis was relatively steady at around 4 cents for RBD, and crude degummed was essentially 0 or a quarter of a penny or something like that. That was due in part to the fact that even though you had this growth in soybean oil use and biodiesel production, you still had enough soybean oil being produced from the soybean meal demand that crushers didn't need to crush for oil. Even though, again, during that period, oil share rallied up. It may have gotten above 50% for a little bit, but I don't think that it stayed well above 50%, and then it came back down. And so because you had enough soybean oil and nobody was really worried about, are we going to have enough or are we going to run out? You didn't see the same translation into basis that I think you will see this time. Further, then while Brazil was in South America was a significant player, Argentina was still the world's largest soybean oil exporter. Their crop sizes were smaller, and so the impact of South American production wasn't quite the same as it is today. And so you have these competing supply and demand scenarios where in South America and the world, really, there's going to be enough soybeans, but the US market will increasingly become even more domestically focused than it is right now. And as a result, think of the demand in the US as translating into basis levels instead of flat price. So the world will determine the flat price. and then domestic demand should determine the basis levels. And that's why I think that even though we're seeing refining margins and RBD basis still well above the historical level, it could be that those turn around and start to go back up, and start to go back up not because everybody's excited about renewable diesel, but because there really is a shortage of soybean oil relative to the demand. Now, I never sort of finished my story about what happened last time. So last time, then it came back and it sort of settled in. So it may be that we're still working through kind of the speculative excess, I guess, or the speculative excitement of the growth in renewable diesel capacity. And it may be that the basis level comes down and ends up settling, but it lower than the current level, but higher than its historical level. And if we just use sort of the futures as a guide, that would suggest RBD basis around 8 cents, between 8 and 10 cents, which is not very far from where it is. So it may also be that we just get a little bit of a decline in RBD basis over the coming year. And then that's kind of the new base level. And then we just go forward and we kind of vary around that a little bit. I don't know. I wouldn't bet a lot of money on either one, because I don't really have a great feel for where I think this is going to settle out. And the numbers that our models spit out seem as plausible as any others, although they don't necessarily match up as well with what we've seen recently in the markets as they have in the past. And so I say all that to say that, one, if you see in not just in biofuel margins, but if you ever see a forecast that just doesn't make sense, like this one doesn't, please reach out. I'm generally happy to talk about it and walk through what I think and hear what you think. And if we disagree, that's fantastic, because that's how you learn stuff. And I am still learning even today. And so I say all that just to say that the biodiesel margin forecast is a little crazy. I know that. I understand that, and I don't believe this forecast 100%. Now, maybe I shouldn't publish it, but I need to publish something, and I just haven't quite figured out how I want to solve this yet. What I probably will do, and I've tried, if you look at our RIN forecast this week, it's substantially lower. It's not as low as the D4 model would like to put it in some cases, because of the D6 support that we talked about several weeks ago. But we have RIN prices coming down to about $1 a gallon and staying at that level or within 10 cents of that level through all of 2024. And I thought, okay, maybe that will, excuse me, that will help moderate the basis a little bit. And it didn't really. And so my choices really are to really raise my basis forecasts a lot, which doesn't feel right given what we're seeing and happen in basis right now. And if we're settling into a range around 8 cents, then that wouldn't work. Or lower energy prices. That's one area that that you could, I think, make a real argument for. However, given the fundamentals of the crude oil market, it doesn't seem like, it feels like this rally is just starting to get going. You haven't had huge demand out of China. I mean, I think China's been buying a lot of oil from Iran and in Russia, but you haven't had, it seems like they took longer to come back from COVID than a lot of other areas. And so it feels like they're just starting to get going. Their economy has some problems too. And so they may not sort of fully get back to the imports that they had when their economy was clicking along at 7%. But as their economy matures, more people buy cars and that kind of thing, and everything just becomes more energy intensive. And so betting that Chinese demand is not going to pull crude oil prices higher doesn't seem to make a lot of sense to me. And so by extension, then you get higher and more sustained diesel and gasoline prices. And so if that's sort of the fundamental situation around this, it starts to get a little bit more difficult to crack how to solve this problem with biodiesel margins. For renewable diesel margins, we don't really have the same problem. In one of the ways I suppose that we can solve it is, or at least make both margins look equally ridiculous, is I could take fat and grease prices down with soybean oil. We're essentially forecasting stable or higher fat and grease prices. We've seen that so far, but if soybean oil drops as much as we expect, then, or as much as we're predicting, I guess, then it would be unusual for fat and grease prices not to follow. However, much like soybean oil, we haven't really seen a slowdown in any of the non-biofuel use for the fats and greases, and their supply is fixed. Most of them, other than UCO, are essentially a byproduct of another process that is not economically related to biofuel production. And so biofuel feedstock demand is never going to mean that we slaughter another cow or pig to produce more choice white grease or tallow. And so while the supply is fixed, demand is growing, that seems at the very least to suggest steady prices if you got falling soybean oil prices. Maybe the prices come down a little bit, or maybe soybean oil comes up a bit to narrow the gap. Either way, unless we raise our price forecast, any change here would just make renewable diesel margins look better. And I think, I think renewable diesel margins could be a little bit better than this. Like I said, we were relatively aggressive, both in our RIN forecast, and we also lowered our LCFS credit price forecast this week a bit. We still have it we've got it weak through the end of the year. I think it goes down to 65 or something. And then we've got it sort of slowly coming back starting in 2025. So those things could help rectify the difference in the margins and make the margin predictions a little bit more comfortable, I guess. But right now, please at least take the biodiesel margin forecast with a big, huge grain of salt, or 2 or 10. Okay. Finally put the question slide in here just in time not to share it anymore. And we do have some questions. Thank you so much. All right, excuse me for that. All right. Do you provide a copy of this weekly presentation on your website anywhere? We do not. If you send me an email, and I know I've been telling people to send me emails, and I'm so far behind in my email, so I really apologize. I hope the person that is on here that asked the question about tallow is listening. I owe them an email, and just so everybody can kind of hear, we have heard sort of anecdotal reports of EU tallow exports to the US, but it hasn't been anything really steady or at a level that would make us change our forecasts at all. It could be, again, much like sort of the situation with Argentinian soybean oil. It could be that the difference or the arb there is open, and you get a couple of little shipments that come in, and then ultimately the arb stays open, and you start to develop better relationships and more volume. But at this point, we haven't really seen that, happen. Now, it may be that there's a little bit more out there than we hear about, but we talk to a lot of people, and I talked to several people, both within fast markets and outside of fast markets, and everybody was kind of in the same camp, that they had heard a little bit and they were curious, but nobody was saying, oh yeah, we've got, you know, 10 ships headed, that are filled with tallow, and we expect 10 more next month and 20 more the following month. I haven't heard anybody say that kind of thing. Anyway, what I was saying was, if you send me an email, there's two ways that we can do it. If there's just one presentation that you want, I'm happy to send that to you. Send me an email and I will send it to you eventually. And then the other is that I have a list that I distribute the webinar to each week. That's just a link, I guess. I can include the presentation with it if everybody really wants the presentation. Otherwise, like I said, if you send me an email, I will try and send it to you as quickly as I can after the webinar. And usually that's not a problem. Usually I'm not as far behind as I am right now, and so usually that happens pretty quickly. Right now it might be a little bit, but I will try to catch your email as it comes by and respond if you send one. D for RIN is plummeting, and you're forecasting it to go down to $1.05. Can you comment? I assume it's partly due to underwhelming EPA mandates and partly due to strong diesel prices. It also points to your earlier comment about using BOHO versus supply demand as a driver for the RIN. Yes, we still do have sort of that quandary, although it seems like it's becoming a little bit less of a quandary given the moves in the RIN prices recently. If you look at it against the HOBO spread or BOHO spread or whichever acronym you want to use, it still is, it's kind of lining up. And especially given the fact that diesel prices have been so strong and we haven't really seen a corresponding response in feedstock prices. Soybean oil wobbly a little lower, and most of the fat and grease prices are really pretty steady, but trending higher. And so in theory, and I haven't quite done this yet, but I'm definitely going to do it at some point in the very near future. We're going to put together a weighted average cost of feedstock, and we're going to start to use that to kind of compare as a replacement for the BOHO spread, essentially. So we'll use that to kind of compare against the biodiesel prices we report to kind of get a sense of the profitability of biodiesel across the country, and then do something similar for renewable diesel. The trick with renewable diesel, or the challenge with renewable diesel, is that we really only get prices for the California market. And so I know that the editorial staff is working hard to expand the energy prices that they cover, both in the US and in Europe and in South America. And so ultimately we'll be doing this for the world, but right now we're just focused on the US. But we'll also do sort of that weighted cost of feedstocks versus the fuel price, and look at that. All of that said, there is, given that at least half of the feedstock that's used, the fats and greases, have been steady or higher, and soybean oil prices have been lower, but not really as much as RIN prices have moved. Now, maybe that's wrong. I haven't looked at a percent by percent comparison, but it doesn't seem like soybean oil prices have fallen, particularly in the last week, as much as RIN prices have fallen. And so it does start to give a little bit more credence to the idea that this may be the year that that RIN prices break from where the way that they traditionally have been priced, and move lower with feedstock costs or as a, sorry, they move lower despite steady or higher feedstock costs. I'm not 100% there yet, but I would say that if there were ever going to be a year where it would happen, I would think it would be this year, just given the fact that that the spread between D4 and D6 is so narrow, and the D4 model really wants to predict lower prices, but D6 is holding it up in some spots. It does seem like that it may be that this year sort of signals that the D4 really isn't so much related to feedstock cost as it is to the supply and demand of RINs. But then next year we go back to feedstock costs. I don't think that this year is a sort of a make or break year for RINs, and by that I mean sort of like, I don't believe that we'll switch to just RIN fundamentals, RIN supply and demand this year and then stay there forever forward. I think that just the shortfall in ethanol production is really something that has gotten the RIN market's attention, and it's not going away. And so that causes some things to happen in that market that aren't usual or standard, and that the apparent relationship to supply and demand as opposed to feedstock costs is one of those potentially weird things that I think might happen. When you provide the next forecast update, yet we're trying to, and I'm trying to get back after 3 weeks that were enjoyable, but also didn't do a lot for my work, being caught up at work, I guess. We're going to publish a report this week, and then we're going to publish a report every week after this on Mondays. So I know I've said that a couple of times in the past. This time, Joao is holding my feet to the fire, and so we're going to do that. Your LCFS forecast seems a bit off. Your price forecast and the bands are a bit disconnected. Is the central value to the correct one or the average of the bands? I'll have to take a look at that. It's strange. So generally it's those two should be the same. So the average of the bands and the central line should be the same. If they're not, I'm not 100% sure why they wouldn't be, but I certainly believe you. There's just one spreadsheet, and then there's the spreadsheet that populates the website, and we had both of those open, so I would think that they would have updated, but I will definitely take a look at that, and appreciate you pointing that out. You're forecasting UCO going up while SBO down, both Illinois, leading to UCO being 7 cents more expensive than soybean oil by the summer of 2024. Is that partly due to CI parity? There was a chart this is a great question. There was a chart that I wanted to include, and I just couldn't find it. I can't remember exactly where I put it. I've shown it one time, and it's essentially the spread between soybean oil and then all of the fats and greases. And the last time I showed it, it showed a trend of all of those prices becoming more tightly correlated, I guess. But at the end of the forecast period, it showed that fat and grease prices were actually at a slight premium to soybean oil. And part of that is the potential for CI parity, although CI parity really doesn't even begin to be a potential until we get the IRA credit. And even then, you're only talking about half the demand, or maybe a little bit more than half the demand. So I don't ever think that we'll actually get to CI parity. And actually, if anything, I think we will, that soybean oil will always maintain a little bit of a premium relative to CI parity because of availability and ease of use and that kind of thing. That said, the forecast for the spreads between the various feedstocks to narrow is driven by, in the next year, is more driven by what's going on with soybean oil, or what we think is going on with soybean oil and the soybean market. Big South American crop weighs on values and tightens those spreads up. It's also just natural that those spreads should tighten. Most of those, like Joao pointed out, in soybean oil and palm oil, most of those spreads had widened to historically high levels in the past year. And now those spreads are tightening up. Now, tightening up isn't the same as trading at a 7-cent premium. And that might be a little aggressive. And it is one of, there's a couple of things that I really am trying to figure out here that I think are critical going forward. And those relationships are one of them. One of the things that we look at every week when we do our forecast is a comparison between soybean oil and DCO prices. It's a little bit of an odd comparison, but the reason that we do it is that in some sense, they're both kind of vegetable oils, I guess. There are also things that are relatively easy to compare. And in theory, I don't think DCO should trade at a premium to soybean oil. But the forecast suggests that we do get to a premium for DCO, just like all of the other fats and greases. And I'm with the models enough to publish those forecasts. However, again, I don't know that I would bet a ton of money that UCO will trade at a premium. UCO trading at a premium to soybean oil suggests that if I own a potato chip manufacturer, I would actually be better if I changed my oil between every batch than if I used it the way that I normally used it. And that doesn't make a lot of sense. Now, that said, again, that's where we are right now, and that's sort of what the model suggests. But I think that probably as we harvest the US crop and the South American crop gets harvested or gets planted, then we'll have a much better idea of how soybean oil prices are going to, or how soybean prices are going to impact soybean oil, and how soybean oil is going to move in the coming year. If we don't get if we get a big decline in soybean prices and soybean oil doesn't follow soybean prices lower, then I probably will go back to predicting, soybean oil at a premium to all of the other feedstocks going forward. If we do get a big decline in soybean prices and soybean oil follows in the futures market, but we don't see we see basis offsetting the decline in futures, probably the same thing. Go back and revise predictions so that we don't have a premium for used cooking oil, or probably most of the other fats and greases. Maybe tallow might be the one that I could see trading at a premium. And then if we don't get a decline in soybean futures, and then we don't get a decline in soybean oil prices, then maybe, because what that suggests is that the US didn't produce enough, South America's not producing enough, the world is just short soybeans and soybean oil. In that case, then I probably would just raise all of the forecasts kind of in lockstep from where they are. I would probably still narrow that spread a bit, but I probably would still suggest that most of the feedstocks, maybe not ultimately used cooking oil, again, since what that implies, would trade at or close to a premium to soybean oil. Any updates on LCFS type programs in other states? The only update I had, which isn't really that new, is New York a while ago, and I struggle to even remember what that was because it was so long ago. So I'm imagining that's not going to be an update for you either. I will check around, and again, if you send me an email, I will respond, and I'll also if you don't get an email back from me by next week, I will talk about it on the webinar next week as well. That may be it. Yep. All right. Thanks so much for the fantastic questions and your attendance as always. Really appreciate that. And thanks to Joao for his comments on palm oil this week, and look for more of Joao on the webinar in the future. All right. I hope everybody has a great week. I'll see you here next Tuesday. Bye.